Hello, everybody. Welcome to the Cyclical Investors Club YouTube channel. As always, this is not individual investing advice. It's just for educational purposes only. Today, we're going to take a look at McCormick stock. They make spices and food products. And we're going to see what we think the stock will do over the next 4 years, medium term or so. I have written on this stock before, and I think it's a good example of some of the dangers. I repeat this a lot, but for retirees that are looking for kind of these stable stocks that they know about, that seem safe, to pay dividends usually, and have a long history of steady earnings, that basically people have just been paying way too much for them, honestly. And so I'm going to try to show this in this article. And I'll have a link to the article in the description as well. So I wrote a bearish sell article on McCormick about 3.5 years ago in 2019 using a similar form of analysis back then. And I think I was the only bear on Seeking Alpha that entire year for this stock. So it kind of shows you how kind of group thinky or ideological sometimes people can get, or just, when something's done really well for a long time, it's hard to bet against it. It's hard to sell it. A lot of people maybe bought a long time ago and they have capital gains. They don't want to pay taxes on them is another thing. So when these things build up, and what I've found is often they skip like a business cycle or they carry through a business cycle. So these trends, I call them sentiment cycles. I think that's what the original article I wrote was a part of a series I wrote about stocks like this. Usually it lasts for like 20 years. Like they have like just a solid 20-year run through at least one recession where they perform well. And they just kind of, my theory is they kind of collect investors along the way. So maybe you bought it in 2005, and now you're retired and you've been holding it for 18 years and it's just done well the whole time and you never have to think about it and you sort of really grow to love it and it feels safe. You understand it. And so more of those investors build up over time, the longer that you can kind of keep a steady run going. And then on top of that, we had a lot of boomers retiring in the past decade, and these are the type of stocks they like when there's not any bonds that were paying any decent interest rates, right? So it's kind of safe and can produce good returns. So those are the people that were in the stock, and that was back in 2019, September of 2019. So I wrote my bearish article. Here's what the stock has done since. Nothing, basically. Here's what the S&P 500's done, 46% return. So keep in mind, this doesn't include inflation, which we've actually had at least the past 2 years. So you need to knock about another 15, 17% off this. So it's really a 20% loss in real terms. That a person that's held this stock for 3.5 years, they might not feel bad. It's kind of where it was all along, basically. I mean, during this time. It had periods where it was higher than where it is right now. But, so it's not as dramatic as like ARK Invest selling off. It's just this, it really is the frog in the pot where it's just kind of like set on simmer and the water slowly increases and the frog doesn't jump out because he just doesn't notice. Like the change isn't quick enough. And there are lots and lots of stocks in the market like this. So I write as many articles as I can. I mean, it's the biggest in terms of absolute. Well, now that the bond market is toast, basically. I mean, now that it's adjusted, I should say, that was the biggest loser for most people. The best thing an investor could have done is just own stocks instead of bonds over the past 5 or 10 years or whatever. So, but the second step is what people did. They were like smart on one hand because they were like, look, these bonds suck and they aren't going to provide the returns that I need. I can go find a stock that maybe can do that. Well, the people that did that early enough did really well, but in the past, I don't know, I'd say like 5 to 7 years. I mean, it kind of probably peaked out different areas. I mean, like REITs was maybe 2016, early 2018 for some areas, and then like if you look at like a 3M or something like that, that's when they peaked, and I warned people about that too. But it hasn't just magically dropped really quickly. It's just been this slow whittling away, and that's how people are going to eventually get hurt. And it's going to cost people a lot of money. It just won't cost them a lot of money really quickly, probably. So that explains this. And I think in that article I estimated like basically flat. This is the annual return, and it's just estimates. I mean, they never come in like exactly right. This is pretty close to exactly right. I mean, it's basically flat over the medium term. That's usually the actual time frame that I aim for, that 3 to 5 year time frame. And so even though we had a pandemic and we kind of came out of it and all that, that probably explains why the S&P is higher than it. I mean, it could easily be lower and not has outperformed as much. But McCormick has kind of done what you pretty much have expected to do, which is nothing. So it's worth taking a look at again now that we've had some time pass. See what it looks like right now. So the first thing I always check is the historical earnings cyclicality. And that is judged by, if you look at the green area here, those are earnings per share. The change in earnings growth each year is down here. And I just look for negative years, and if there's some that are more than like minus 50%, then that's kind of a cyclical stock, and I use a different form of analysis for it than an earnings-based one, because the earnings change so much that it doesn't give you a good read on what the medium-term returns are going to be. They were all positive years until this last year, and they fell 17%. That wasn't modeled into anything that I did. I assumed earnings would probably still grow, but that it's just not worth as much as people are paying for it in my last article. So it's not really cyclical. This could be worrisome. Usually the way I do it is, if I can't tell exactly what's going on and the reason for the decline in a particular year, I mean, I am willing to give a business 1 year. Bad years happen, fluky things happen. They might decide to write off stuff in a year or something, whatever. You can have a somewhat bad year, and that's no big deal to me. But it does put you on guard, because if this trend starts going, so they're only expecting 2% growth this year, okay, if they disappoint just a little bit, now you got 2 negative years in a row, and you are, maybe I can move myself here. I accidentally clicked that. So then you would have 2 negative years in a row, and now you should be getting a little more concerned. The metric that I watch to watch out for that, if I did own this stock and then the valuation wasn't so high, I look at 3-year revenue. So if the revenue after a 3-year period is lower than it was 3 years ago, I sell. I don't buy, and if I own it, I will sell it. And I have sold stocks. And usually investors are a little bit slow to recognize that. Like all these investors that have been bidding this stock up all this time, a few of them will get out. Some of the professionals will get out. But a lot of people will just be a little bit slow. They'll be looking at their dividends or whatever, and they really like it too much to sell, or they don't want to pay taxes. There's a lot of reasons, and it can give you enough time to usually get out of a stock. So I wouldn't count this totally against whether to buy or not, but it will be taken into account in the metrics that I do. So it's good. You can use an earnings-based analysis on it. They've actually been issuing shares instead of buying back shares. Because I'm using an earnings per share in order to estimate earnings, these increases in share issuances, probably compensation, most of it, except for this looks like an acquisition, those will automatically be taken into account. So I don't really need to make any adjustments, but I always like to show that. And so now we get down here to the good stuff. So the first thing we need to do is select a time frame. I selected 2015 through 2023. That gives you kind of what they're doing more recently, but it's still quite a few years, so you have quite a few data points. You have stuff before the pandemic and everything like that. All right. So I also am going to use 2023's earnings so $2.57 per share, which works out to almost a 29 PE ratio, and or a 3.36% earnings yield. So these are connected. Now, when I calculate the earnings growth rate, I take into account this 17% drop in earnings, and that's really the only adjustment that I make. And I get a 2.76% earnings growth rate. That's almost the same. It looks like Fast Graphs is 4.76%. Fast Graphs looks like it's 4.8, so it's almost the same. I didn't really make many adjustments. So that should be pretty uncontroversial. Like, there's nothing really difficult or special going on here. We have basically a 29 PE stock trading at, we'll call it 5%, with 5% earnings growth. On its face, anybody who's done this type of thing should realize that's pretty expensive still, just on its face. I mean, I'll get into it. Well, we'll just keep scrolling until we get into it. So now I had a few questions about kind of the way I think about this and the way that I try to calculate it. And sometimes it's hard to make kind of complex things simpler than they can be. I mean, I'm always trying, and so that's one of the reasons why one of the new things I do is I post these tables here with the earnings to just try to show how I'm thinking about this. So the earnings yield is 3.36%. That basically means if you bought this company for $100, okay, you would earn $3.36 per share in a year. So it's it doesn't, like, if you just think about it in your head, you can think if those earnings didn't grow, okay, you would just collect $3 every year, right? And so this, or 336, so it'd be 336, 336, and then you can see how much money you would collect after 10 years, right? If you own the business, like, you could take that money and go spend it or whatever if you own the business. So all I'd really do is I say, okay, earnings are probably going to grow. They aren't going to stay the same every year. So I calculate that in, and that's what the earnings growth is for. So I pull forward the first year, so I assume the growth on the first year. So I assume you'll get $3.62 the first year, okay, if you paid $100 for the business. And then that grows at 4.76% each year, and then you collect that extra amount. So this first column on the left is how much it grows each year. So the first year is $3.62, and that grows at 5% a year. So your last year, you're collecting $5.50, right? That's how the earnings growth is. But this is kind of fresh each year. So this year you get this amount, this year, and so the right-hand column here is the cumulative amount that you would collect over this 10-year time period. And you would collect about $45, right? So you would only earn like half your money, less than half your money back after 10 years that you paid for this business. And all I do is I just put this in a CAGR calculator. So you start with $100, you end with $145. After 10 years, what kind of CAGR is that? And that's a compound annual growth rate, the CAGR, of 3.79%. That's the return you can expect from the business if it was just like a private business, basically. There are some small differences, but I mean, that's the way you can think about it. So that's not a very big return. I mean, not when you can go put your cash in the bank and get more than that. You can get like 4%, 4.6% right now. I think on a 10-year treasury, you're probably right close to this amount, and you take no risk of this. Your $100 is not at risk then. Your $100 is at risk in a stock. It can go below $100. I mean, the price goes down, and if you just sold it after 10 years, whatever price it is what you would get back. So you could actually lose money in nominal terms. So that's how I think about this. It doesn't take into account market sentiment at all. It only takes into account the earnings of the business and the growth of those earnings and what you're paying initially for the first year's worth of earnings. So, and that's what the PE and earnings yield are. 29 PE is about, 3.3% or something like that. And that's what it translates to, right? Most of the people that own this stock right now, they never did any of this calculation. I mean, I can tell you, because this is just one of those ones that's really obvious. It's really obvious that it's not going to give you a good return unless something kind of dramatic happens and they grow a lot more than anybody expects, or that they've ever grown in the past 10 years or 20 years. So if you add up that return after 4 years, you get like 16%. Okay, because I'm looking 40 years into the future. And so that's a decent place to just estimate. I mean, you're just trying to estimate everything, compare it to how other stocks are, and get an idea of what the value here is compared to alternatives. So the first thing I do is I compare it to the S&P 500. I compare it to cash, which is T-flow. So that's what this thing is here. S&P 500 right now, I roughly expect a 27% return, cash over 4 years. Cash a 17% return. So it would underperform a little bit here. It'd be almost the same here. This is basically similar returns. Now, in some ways, if you expected market sentiment for the stock to remain exactly how it is now, this is reasonable, right? Because that means it's just properly valued. It's valued the same as the S&P 500. It's valued about the same as cash. But the question we have to ask ourselves is, we're going from a time period where we had basically 0% interest rates to a time period where we're going to have interest rates are already higher. So we know they're going to be higher for at least part of these 4 years. And so it's unlikely that people are going to be continuing to pay, and demographics are going to change, there'll be fewer, I don't think boomers peak until like 2030, so we wouldn't be there'll still be a lot of retirees looking for this. But if you're a retiree who's attracted to this stock and you've owned it a long time, it's much safer to get cash, to go to cash. And then you don't have to worry if the market declines because interest rates are higher. And you don't have to worry about the market re-rating, okay? And we already see the beginning of this. People are taking money out of deposits in banks, and they're putting them in money markets, and they're putting them in treasuries. And that's what's causing the problems that we have in the banks right now. So this process has started. I think it will eventually work itself to these type of stocks in the stock market. It's a little bit trickier if people have to pay taxes on their gains. That usually holds people back. That's not something I do. But it might keep some people in these stocks. But again, over time, it's just, it will whittle this stock down. It will. Or it will stay the same, and inflation will just eat away all of its, it won't earn anything. It will do what it did the last 3 years. So if you get another 4 years of that, it won't be long until you have a decade where the stock did nothing, and you have inflation on the top. You end up losing 50% of your value even though you can't see it, which is probably what's going to happen. So this next section, I try to take that into account. I say, okay, look, if we go back in time when interest rates were normal, and let's say inflation's 3%, cash yields a little more than 3%, 4% or something, and then you kind of work your way up the risk scale on what you demand in terms of return. Usually, about a 7% earnings CAGR is what the market kind of on average pays for things. That's the same as like a 10% earnings growth on an 18 PE stock, okay? If that sounds reasonable to you, if you think, yeah, a stock growing at 10%, paying an 18 PE for that on average seems reasonable, doesn't seem way too high or way too low, then this next section should be reasonable too, because that's what this assumes. Now, there are some stocks that the market just always pays a little bit more for, but kind of like 3M, yeah, they pay more for them until they decide not to pay more for them. And even if it's a slow process, the end result is you still lose 60% of your money, or your purchasing power and money. So if this change happens over the next 4 years, you can expect a 36% loss in McCormick. So it might take longer than 4 years. It might not. If it does, this will be just stretched out over time more. If we have a deep recession, it could happen much faster. So this underperforms the S&P 500 by like 50%, and it underperforms cash by 50%. So that's a huge difference. And that's basically what we've seen the last 3.5 years. I mean, we saw, a 46% spread between this stock and the S&P 500. Now, I think the S&P 500 is probably a little bit overvalued here, but you can just see how it happens. We basically had a model for it the past like 3.5 years. So to me, this is a really dangerous kind of situation. There's just no need to get into it when you can have cash, right? So that's what I try to explain here. You're looking at basically potential. I mean, if I had estimated, it might not take 4 years or whatever, but you kind of get the relative danger, right? So you're looking at flat to negative returns on this stock over the next 4 years or so. And to me, that equals a strong sell. I get into my defining kind of what I consider a strong sell. And if it's more than 2,500 basis points worse than cash and S&P 500, then that's a strong sell. That's a pretty good sign. The odds are pretty slim that it's going to outperform or that it's going to produce good returns. And that's how I think about that. So I kind of talk about some of that here. I've actually added a lot more commentary in my video than I did in the article. But yeah, I talk about the purchasing power and everything, which I talked about already here. So if you have any questions, you can ask them in the comment section. You can link the article if you want to go read it, look at the numbers, and I'll do my best to answer those. We have tools in the Cyclical Investors Club, which is $30 a month, or $300 a year, which translates to like $25 a month if you get the annual subscription, where you can just enter in the data and it will tell you the 4-year expected returns, the relative returns, expectations based on that, and you can use that for basically any stock. And then I have lots of other strategies and stuff too, but this is a pretty straightforward one, I think. I don't think it's really should be too controversial here. All right, thanks for watching, and I'll see you in the next video.